SUERF, the European Money and Finance Forum, bringing together policymakers, finance, and academia.
Welcome to the SUERF Baffi Bocconi e-lecture on key findings from the 2023 EBA EU-wide stress tests. On 31st January 2023, the EBA launched the 2023 EU-wide banking stress tests. Results were published in the middle of the summer on 28th July. Today, key findings will be presented and discussed by senior EBA and ECB regulators and supervisors, as well as private sector decision makers and analysts. We are privileged to have with us today Gyntelberg, Director of Economic and Risk Analysis at the EBA, to present key findings. Then, SUERF Fellow Professor Rym Ayadi, Chair of Banking Stakeholders Group at the EBA, and Professor at Bayes, previously CAS, Business School, City University of London, and Senior Advisor at CEPS will moderate a panel of top experts. We are pleased to have with us today Christoffer, Head of the Banking Supervision Stress Tests Experts Division of the ECB's SSM, Nicolas Charnay, Sector Lead for European Banks at Standard & Poor's Global Ratings, and Marc Irubetagoyena, Head of Group Stress Testing and Financial Simulations at BNP Paribas. Without further ado, may I hand over to Jacob and then to Rym.
Thank you very much, Ernest, and hello everyone else. I think we've seen each other in various settings over the last couple of years, so it's good to see you're here to support the conversation. It's clear, I hope, that we're doing a stress test this time around in a very different environment compared to the previous ones, right? So for a long time, the stress tests that the EBA conducted were basically about low rates, flat rates, zero rates, lower for longer, and what that meant really for the bank's profitability at the first instance, and hence with low profitability, how robust would the banks be to macroeconomic shocks, right? So this time around, it's a very different setting, as you know, right? The inflation and hence rate environment around the world, Europe included, is very different. I think the geopolitics look different, right? The outlook from a macroeconomic perspective is more uncertain, I think, than in the past. And I would say that is, I think, an important thing to remember. The other thing I would say is, as a sort of as an entry comment, is that obviously as time has passed since the 2008 financial crisis, banks have been forced by regulators, by law, if you will, to increase their capital holdings quite a bit, right? So at some level, we have had a continued process of more capital in the banks relative to the assets, and we have a very different outlook, right? So I think just as we go through the findings, I think it'll become clear that that change relative to previous stress tests is quite noticeable, yeah? If we move on to the next slide, please. Now, I think overall, what we have from the stress test is that we can clearly see that the European banks are likely to remain resilient under a quite adverse economic scenario, which in this case combines both a very noticeable EU and global recession, higher interest rates, higher credit risk spreads, but also, I should say, quite noticeable declines in commercial and residential real estate prices, higher commodity prices, and I would say a quite high level of unemployment given where we are today. Yeah. And the scenario was constructed and construed and debated quite aggressively, I think one can easily say, during the last quarter of 2022. So needless to say, this was a period of time where we were trying to figure out what is a likely credible stress path for interest rates and credit spreads, with quite a bit of uncertainty about where monetary policy was headed, right? Now, I would say that from that perspective, we've done okay in terms of hitting a still stress, and we're still above what's actually happened. But I think just to make it clear, it's not always that easy to do these exercises, right? If I look at the resilience of the banks as we see it, yes, banks came in with quite a high level of capital. And I would say pretty much all of the banks were sort of around 15%, many of them higher, a few a bit lower, but still fairly high capital ratios for the majority of the banks in the exercise. If we look at the depletion that comes about, it's a 459 basis points decline in the CET1 ratio. So it's quite a solid drop. As you can see, we end up from having a 15% capital ratio to a 10.4% capital ratio. So quite aggressive scenario and quite high losses for the banks. Now, why is it not worse, you might ask? Well, again, the banks are making more money, right? Earnings are up, and asset quality is also much more robust this time around than in the past. Those are the two main reasons, I think, why even though we have a very severe scenario, the banks come out still looking okay, right? Needless to say, I have to say that there is substantial macroeconomic uncertainty, right? So in a sense, it's good news that the banks are as robust as they are, because some of the more pessimistic ones of us would say that, yeah, they're going to need it, right? Just to make clear that there is substantial uncertainty about what's going to happen. So it's a good sign that the banks are well capitalized and seemingly quite robust here, right? If we move on to the next slide. Now, what we've done in this year's stress test in terms of tweaking it a little bit is that we've added more banks, right? So we've gone from 50 to 20 banks. Notably, we have 75% of EU banking sector assets are covered. What's interesting for me is we now have Greek banks in the soup as well. They were not in before. We've kicked out some public sector banks. A few still remain. But I think coverage overall has been improved quite substantially, both in terms of assets, but also in terms of geography in this exercise. A second innovation is that we now, for the first time ever, have introduced a top-down model. So we've centralized some of the calculation work, and that we've done for net fee and commission income. Finally, we've added a few bits and bobs on sectoral composition of the bank's exposures to get a better sense as to which sectors are, or let's say, the drivers of the credit risk losses. To my mind, that's also sort of a first step towards some of the work we need the banks to do to participate in climate work, which is a sectoral discussion as well, right? So there's a little longer term agenda on that front. But clearly the sectoral aspect is something that both the supervisors asked for in terms of being able to assess what's going on, but also, to my mind, a reflection of the reality we're in during COVID, and also the Russian attack on Ukraine and the resulting energy price shock, and what that means for commodity prices. And I would say down the line, the rejigging of global supply chains is also part of that storyline. Yeah. So there's another more pressing and real economic reason for the interest here from our side. Yeah. But those, I think, are the main innovations. Let me just flag a couple of sidebars on this one. One is that we obviously had to deal with the end of central bank financing of banks, right? So we've had a little special component where we allowed the TLTRO paybacks to be covered by central bank deposits, provided they were held with ECB. So that was a softener, if you will, right? The other thing that we've done on the side is that we've added memorandum items to cover the change in accounting principles for insurance. So there's an IFRS 4, IFRS 17 component, which is hidden somewhere in a box. And there's some extra numbers that are being provided, right, just to get a sense of how important that is, as that's a pretty significant accounting change for some banks, right? That, again, a memorandum item, I know that Christoffer is going to look at me and say, yes, but we haven't had time to fully quality assure every nook and cranny on those numbers. But we thought it reasonable to have those numbers in to provide some sense of how important that is, because we know it was important for certain banking groups, right? If we move on. Now, again, on the capital side, as you can see, robust capital ratios, NPL ratio, as I alluded to, quite high asset quality. It's only gotten better. So the riskiness of the books that the banks have is lower at the entry point to this stress test than ever before. And if you look at return on equity, it's not super high, but it's at least higher than it has been pretty much in the previous decade, right? So the banks are making more money, which is an important additional component when we understand what happens in the stress test. So Rym, you're nice sideways, which is interesting, but is that deliberate? Sorry. If we move on. So if we look at the capital ratio developments under our two scenarios, right, you can see that we start out with the blue bar there on the left panel. And then you can see the two scenarios, that the green bars being the adverse scenario and the yellow bars being our baseline. So as you can see in the baseline, actually capital ratios go up a bit, almost 1.5%, whereas under the adverse scenario, we're down 4.6%, as I said, right? So quite a big difference between our baseline scenario, which is still, I should say, not overly optimistic compared to what we have. But the adverse, as you can see, is quite severe. Yeah, I think that's the first one, right? And it's so that tells you something about how we've created a spread here, right, in terms of the baseline and the adverse scenario. If we move on, here's the underlying scenario, right? So quite substantial shocks to GDP. As you can see, rates are up quite a bit here, yeah. Higher rates and a much more pronounced increase in the beginning. And inflation is matching the interest rates. The cumulative inflation numbers are quite high. So 3 years average of almost 7% inflation. Obviously, it goes down a little bit over the time profile, right? But just to give you a sense of how different the scenarios are in past stress tests compared to this one, yeah? If we move on. Here's sort of a breakdown of where the meat is and what drives the outcome, right? So this is, again, sort of an average graph, right? So as you can see, your net interest income and other P&L items, they add up to positives when it comes to capital, whereas really, the cost of running the banks, credit risk, and market risk are the other main elements, right? The one that is maybe a little bit worth noticing as well here is also the increase in risk exposure assets, right? So as things get grim, risk weights go up, and that means that risk-weighted assets grow, which means that then capital requirements de facto go up, right? So just to say that, as you can see, net interest income, net fee and commission income, but then also costs, credit risk losses, and market risk are the main drivers of what we have, right? And if it's the losses side, it's really mostly credit and market risk losses that are worth talking about, right? Op risk is there, doesn't seem to be much of an issue, but it's there, right? So mostly about credit and market risk, yeah. If we move on, here are the credit losses. First to do those, right? So if you look at what we're doing here, it's quite a big shock, from a steady 40 billion in losses in the baseline scenario. The adverse is 4 times as high, 2.5 times as high, double as high over the years in terms of what the credit risk losses are, right? So again, this is another way of looking at. I showed you one graph that gave a sense of the big gap between the two scenarios, right? This confirms that this obviously flows through the bank's balance sheets, as one would expect, right? With substantially higher credit risk losses under the adverse scenario. If I look at loss rates, just to be clear, they are pretty much the same in this stress test when I compare to the previous one, maybe a little bit lower, but not a lot, right? So it's not as if the higher asset quality is that big a driver here. You see pretty much the same loss rates, right? But it's just to let you know that that's sort of where we are, right? There's not that much of a difference here. If we move on, here's the sectoral breakdown. As you can see, there are clear differences, right? On the chart, I'm just going to flag a couple of them, right? Construction, accommodation, and food services are pretty severely hit. Real estate also takes a hit. That corresponds in part to the scenario aspects, which have quite substantial hits to real estate prices, right? If I look at the energy intensive sectors, you can also see that they come out looking a lot less good than the less energy intensive because of the higher energy prices, right? So we have some of the elements of a commodity energy price shock hidden inside the scenario as well, and that flows through what we get here on the sectoral breakdown. Yeah? If we move on. Here, I would just say, again, as you can see, the higher interest rates are obviously a benefit to the net interest income side of the banks, right? So in the baseline, quite a bit of increase in net interest income. In the adverse scenario, it's sort of, they're high, it takes a dip, but then they sort of rebound a little bit, right? But still, again, as you can see, there's like a 50 to 60 billion euro gap between the baseline and the adverse scenario when it comes to NII. Yeah. So again, the difference between the scenarios is, I mean, at the peak, it's more like 80 billion, I should say, right? So substantial. Now, what we can see is that there are differences across the banks where there's sort of a tendency to such that banks who are more variable rate banks on the asset side do a little bit better on the net interest income side, right? Which is what you'd expect if banks were running the banks as they should, just to be clear. There's no shock here, but it is in a sense reassuring that also shows in the data, right? If we move on, here you can see a net fee and commission income. So those numbers are calculated by a top-down model. So that's an model estimated jointly by supervisors and regulators and validated aggressively. I think Christoffer will know we spent several months trying to get this one right. It's not so easy to make a net fee and commission income model for the European banking system, to be honest. But as you can see, the difference between the baseline and the adverse scenario is also noticeable here, right? I think is the main takeaway, that it is, again, you take quite a bit of a ding, almost 50 billion difference in income, right? And then it becomes 30, and then it becomes 25, yeah? So roughly 100 billion less in income over the 3 years in net fee and commission income under the adverse scenario relative to the baseline, just to make that clear, yeah? If we move on, here's the market risk stuff. I'd say the main point I'd like to make here is that you can see in the left-hand panel that similar to previous years, you take a big hit in the first year, it's a shock, right? And then you rebound. So you lose a lot of money and then you make it back a little bit in the following 2 years, right? So here, as you can see, it's a loss of roughly 135 billion year one. And then you make roughly 40 billion the following 2 years, at 2 times 20. And that gives you sort of roughly a little bit less than 100 billion in losses from market risk, right? But it's a very skewed profile, yeah? So it's a big hit followed by a rebound, yeah? And you can see it's mostly the market value of instruments and its net trading income that are the main drivers here. And then you can see what makes you money in the last 2 years of the stress test period is client revenues. Really, that's about it. Yeah, there's a little bit of counterparty credit risk, but it's not a big number. Yeah. If we move on, operational risk losses again. Here the baseline has low operational risk losses, whereas the adverse has high, right? Again, quite a sort of a 10 billion difference 3 years in a row, más o menos, right? So that's another 30 billion difference between the baseline and the adverse. But again, not in the big scheme of things, maybe not so much, but still it's there, yeah. And it's, I'm going to say here, this is a debate. I'm not sure what truth is here, but in terms of conduct driven and sort of operational risk losses, it's sort of a 50-50 split, it seems, based on the bank's own input. Yeah. If we move on. So it's clear that the RIA development is mostly a credit risk thing. That shouldn't be a surprise, right? So, you know, and it's either banks with IRB models or banks with standardized approach models. But as you can see, it's mostly the IRB banks that drive this one up, right? There's also more of them as the banks are larger in this sense, right? So, yeah. If we move on. So here's a bit of, if you haven't looked, I think you'll find there's an awful lot of transparency provided, right? There's close to 200 megabits of, if not more, data, right? If you unpack it and put it into a database, it grows. It's just heavily packed for you. So there's quite a bit of detail, right? Both on SSM and non-SSM countries. And if you haven't looked, have a go, right? It's all there. It's quite a bit of transparency provided. If you find bugs in the numbers, please let us know. We'll see what we can do. If we move on to the last slide, I think, yeah. So what we've done is that we put out a report, right? There's a lot more in the report than I'm saying now. There's a whole bunch of boxes and extra little tidbits and nuggets in there for you to read. And then we've got both PDF files for each bank. We've got for the transparency templates. We've got a number of automated tools you can use online, and we put out the entire data set from the stress test as CSV files that are easily importable into whatever tool you might want to use, right? So we try to be transparent and give the full Monty. I think the discussion we're having now is, do we want to do more, possibly just provide each bank's templates as Excel sheets, put them out so everyone can see. That might also help if you're looking at a particular bank, right? That might help you. I know, see, we have a man from S&P now nodding, so he doesn't have to do the work himself, right? I mean, it's not, we're not on purpose trying to make your life miserable. So that's being discussed, right? Just to be clear. But I think that is, I think that's all I had to say, right? There's obviously a ton of other stuff we can talk about, but I know there's people here who's going to say more, right? So Ernest, I'm gonna give the floor back to you. Yeah, thank you.
Thank you very much, Jacob. I assume that I'm taking after you the floor, and you see me well because I have some issues with my WebEx today for some reason, so I'm sorry for that. Thank you very much for this comprehensive presentation, but also really the details that you have provided for this stress test. This is really great news. Of course, you mentioned that you have increased the number of banks from 50 to 70, covering 75% of EU banks. It's a good effort, but I think we would like to see coverage of hopefully 100% of the European banks. And I know that you're laughing about it, but we can see that, for example, in the case of SVB in the US, this was a really small bank, or called regional bank, which has created a big turmoil for the banking sector in and this could also be the case in Europe. So when we make I would say a conclusion that EU banking overall is sound, perhaps and robust, we need to be a bit careful for that statement and simply say that we are covering 75% of the EU banking. And I think this is also important. That gives really the right conclusion, in fact, to the market. Now, besides this, I think we have seen quite a turmoil over the last months, and all of us we've been waiting. What would this turmoil in the US and Switzerland mean for European banks? I think I would say, hopefully, it did not really have a contagion effect, although we have felt that there would be, but it was completely contained with some very clear statements by the supervisors, whereby they have taken a very clear position on that. So let me turn to the stress test. I think stress test and scenario analysis are very important tools for supervisors to test extreme scenarios conditions and to enhance also bank soundness and resilience by really the preparatory effects they have on European banks. But still, based on your conclusions and assessment, there are many questions that need to be discussed. Of course, stress tests, they still rely on specific models, assumptions, a level of granularity of data, and also data availability. So it's still not, as you say, we clearly know that it's not the perfect, I would say, environment to have all the data we need. And also, we still can say a lot about the assumptions behind those stress tests. Now, credit risks, as you mentioned, are driving the overall profile of risks, and they can be relatively easier assessed because data is there when extreme scenarios are carefully calibrated. But again, I have concerns about market risk, about climate risks, about geopolitical risks, operational risks, and reputational risks, and any other risks that, of course, we might have. And these are all not taken into consideration, in fact, or partly taken into consideration in the stress test. So obviously, what can be learned from the regional banks turmoil in SVB in the US and in many other countries, like, for example, Switzerland, for example, I don't want to say it, but stress tests mainly failed to account for example, business model concentration risk, and also supervisory lack of oversight, particularly in the case of the US, and it was really practically informed by the Fed in their reports. And then also the level of complexity of certain institutions that could be completely outside the stress test that as being devised currently. I just wanted to share with you also a recent commentary by a colleague of mine at the Center for European Policy Studies, Karel Lano, who has had quite a critical view about the results of the stress test, and I would certainly invite you to read it. Overall, he thinks that this might be providing a false sense of safety since it leaves away many aspects out of the assessment of the banking industry. Now, in this panel discussion, I'm very happy to invite the panelists, and I'm sure they will inform from their point of view a bit more on what their views are on the stress test, and it would be interesting also to have their opinion on what can we learn from the SVB and the Credit Suisse for this to enhance or to strengthen the stress test. Also, I have a few questions related to the fast growing bond market in an environment where interest rates are going up still, and high level of government indebtedness and also corporate indebtedness. So what it means in terms of the stress that we will see on the European banking industry. And finally, I mean, if we would see a fast deposit withdrawals, specifically in an internet age where a lot of fintech and I would say cryptocurrencies and all of this, and particularly in the absence of centralized emergency liquidity assistance at EU level. And last but not least, the climate risk and green transitions and how to deal with it, and specifically the transition risk. And this is, I know that there will be stress tests related to climate, but what we would like to see is mainly an integrated stress test that take into account all the aspects of risk in the European banking sector. So with this, I would like to give straight away the floor to Christoffer to inform us a bit what ECB is doing, and then his view on the EBA stress test. Please, Christoffer, the floor or the screen is yours.
Yeah, so I will provide an ECB perspective to the stress test, explain a bit our approach to the exercise, because of course we are very much party to the exercise, as we are one of the competent authorities that are collaborating with the EBA to run the exercise and conduct it on the banks that we are supervising. So I will say a few words about how we do that, and then talk a bit to the results as we see them, and then also importantly how we use the results for our supervisory follow-ups. Let's see if we can move. Yeah, so apart from the fact that we have an obligation to take part in the EBA exercise, and then of course also by legislation as a competent authority, supervisory authority, we need to run an annual stress test on the banks that we supervise. We have a number of objectives that we are trying to fulfill with running the stress test, such as assessing the resilience of our institutions to adverse developments, and then of course that the findings from the stress test will be feeding into our supervisory review and evaluation process, so the SREP, to help calibrate capital and potential liquidity requirements, and as well as making sure that banks are complying with sound risk management processes. But we also use the exercise more broadly to support other supervisory activities. In the case of the 2023 exercise, some of the focus areas were really whether to what extent banks are able to properly aggregate their risk in a timely manner. We also had a deep dive on leveraged finance. I will come back to that. And we also, as Jacob mentioned, also had a focus on sectoral credit risk exposures, commercial real estate, and counterparty credit risk. Now, in our case, we are of course part of the EBA sample, and as shown in one of Jacob's slides, the SSM part of the sample is kind of the majority of the banks of that. That means that we have 57 of our significant institutions that take part in the EBA part of the exercise. But we also run the same exercise more or less for the rest of our institutions that we directly supervise. There are a few banks that are under restructuring or mergers that did not take part, but otherwise we ran the stress test for 41 other SSM significant institutions. So in total, 98 banks were part of the exercise, which also means that in terms of overall coverage for what concerns the EU area banking sector, it's actually more than 75%. It's closer to 85%, I think. So quite a big coverage. But otherwise, the two exercises are really run in parallel, and we follow the same EBA methodology, run the same based on the same scenarios. But for the SSM only part of the exercise, for the 41 smaller institutions, there are certain proportionality elements that we apply, and also in terms of the publication of the results, it's also much less granular, although we do publish also their individual bank results. Now, how do we approach the exercise? Of course, this is a constrained bottom-up stress test, meaning that based on the common methodology prescribed by the EBA and the scenario that is provided, the banks are to a large extent providing the projections based on their own models and methods, and in order to make sure that we have, say, credible and sufficiently prudent outcomes in the end, we, from the ECB, but also the other competent authorities that take part in the EU-wide exercise, run a quite thorough quality assurance process. In our case, we are more than 200 people working on this for 6 months or so. And we approach bank submissions in this case from various perspectives, both looking really at basic data quality, compliance, but also, of course, whether banks comply with the EBA methodology. But then also in terms of the projections and the economic meaningful of the numbers, we've used different methods to challenge the banks using our top-down models, using peer benchmarking, but also taking into account bank-specific knowledge coming from our line supervisors that of course follow the individual banks closely on a day-to-day basis. And then finally, we also look at the result from a more holistic perspective to help prioritize the issues we find using our challenger tools. Now, in terms of the key takeaways, I mean, this is broadly similar to what Jacob presented, of course. What I'll be presenting now is really based on the 98 banks that are under our supervision. So the numbers are slightly different from what you saw in the previous presentation, but I think that the general findings are similar, also due to the fact, of course, that our banks dominate the EBA sample. I think, I don't know, Jacob, you know better, 70 or 80% of the banks of the EU sample. But okay, the overall finding is that we saw between the last exercise in 2021 and the one we ran this year, there were significant improvements in both asset quality and profitability, which help make banks more resilient to shocks. So although the adverse scenario were quite severe this time around, overall banks were found to be quite resilient to the shocks. But at system level, our CET1 ratio drops to 10.4% at the end of the scenario, which in our case corresponds to around 480 basis points. So a little bit higher than what you saw in the EU-wide sample of the EBA. This notwithstanding the overall resilience, there are a number of banks that under the adverse fall below certain thresholds. Most of the banks, or the majority of the banks, or 53 banks, fall below the so-called MDA trigger, and 9 banks would fall under the total SREP capital requirements and or the leverage ratio requirements. But I think it's important to mention here that this is not a pass-fail exercise, so there will be no, say, direct capital requirements or capital raising requirements to any of the banks. This is the findings are feeding more into our, say, into the SREP, to the supervisory dialogue, and then maybe some capital actions after that, but there's no direct link. But I will talk more about that later on. A bit about the results. Some of it also is kind of reflected in what Jacob presented. This first slide simply summarizes some of the key improvements we saw in banks' balance sheets since the last exercise, namely that asset quality, so the NPL ratios, the cost of risk, has improved significantly, in particular in certain jurisdictions which, say, previously high NPL jurisdictions. There has been a lot of cleanup to reductions in NPLs, and that it has been one of the key drivers of the results in terms of the relative ranking of banks in this exercise compared to the previous one, due to all these balance sheet cleanups over the last few years. And then again, of course, we have noted quite significant improvements in profitability also due to the rising interest rates. So banks come in with higher profitability buffers that help shield them a bit from the shocks that are imposed in the adverse scenario. Now, in terms of overall impact on the capital ratios, again, here the story is quite similar. So depending a bit on how you look at and which definition of capital you look at, the results came in around 480 to 500 basis points in terms of overall capital drawdown. The right-hand side chart shows the capital ratios at the starting point and under the stressed, under the adverse, say the outcomes under the adverse scenarios, covering basically all the different stress test exercises the ECB has run, either the EU-wide ones or some of our own since the inception of the SSM back in 2014. And as you see, although from exercise to exercise, the capital drawdown differs a little bit, primarily due to differences in scenarios. The overall increase in capital levels also tend to show that say the overall resilience in terms of the stress capital ratios that come out of the stress test has been increasing by around 2 percentage points since the first exercise back in 2014. So that again goes to say that the resilience has been improving over the years. Now looking a bit at some of the key drivers as we see them in terms of also the relative ranking of banks. One thing that is notable is that banks that come in to the exercise with lower cost to income ratios or have higher cost efficiency or higher profitability tend to perform better because of course that helps shield their capital from losses that are imposed under the adverse scenario, and that's what you see on the left-hand side chart. Maybe one thing to note in this say inflationary scenario, there was actually quite a bit of push up on the administrative expenses under the adverse scenario, so that was a kind of a negative implication. But by and large, if you come in with better cost efficiency, you also tend to perform better in the exercise. On the right-hand side chart, we show that say the relationship between returns that banks earn on specific portfolios and the cost of risk, so the credit risk. There's a positive relationship there, which is more or less as you should expect, but also in this higher interest rate scenario where banks are posting higher interest rates, that also tends to come with higher credit risk. So because also if you have higher net interest income or are able to generate more interest earnings, that of course also has implications for the borrowers in terms of higher interest rate payment burdens, and that in turn can lead to higher credit losses, and that is kind of well reflected in the results. But that said, again focusing a bit on net interest income, which was a key driver in this exercise, also given the change in the scenario configuration from the low for long type of scenario to the increasing interest rate scenario. This was quite a key driver. The asset liability structure of individual banks determined whether they benefited or not from this increasing interest rate scenario. And what we observe is that banks whose asset tends to reprice faster than their liabilities under an increasing interest rate scenario tend to generate higher net interest income, and that in turn is very much driven by, on the one hand, the extent to which they rely on wholesale funding, which tends to reprice faster than say retail deposits. So if you rely more on wholesale funding, you suffer more in terms of interest expenses, so that drives down your net interest income. But on the other hand, if you have more floating rate loans, your assets reprice faster, and that tends to push up your net interest income. But that again, as shown in the previous slide, comes at a cost of higher credit losses, all things being equal. Now, lastly, focusing a bit on credit risk, I will not spend too much time on this one because Jacob also already elaborated on that. But we saw again that, I mean, credit risk is as always one of the main drivers, and what we observed was that, say, retail, so consumer credit exposures, and also corporate exposures, in particular commercial real estate and leveraged finance loans, tend to be main drivers here. And also when you focus on the sectoral dimension, which, as Jacob mentioned, was a new thing, we observed again that certain sectors like accommodation, food service, construction, manufacturing, and energy intensive sectors in general suffered more. One of our supervisory findings, though, were that banks still have, or many banks still seem to have some problems properly modeling credit losses at sectoral level. So that, of course, is an issue that we will be mindful of going forward. Then lastly, at the ECB, in the ECB part of the exercise, we also had a deep dive on leveraged finance due to the fact that this has been a priority topic for some time among our supervisory priorities, given the strong increase in leveraged finance activities by some of our largest banks in particular. That's what you see on the left-hand side. And also given the fact that leveraged finance, or leveraged exposures, tend to be more cyclical and more risky in terms of changes in the cycle, and therefore we had a special deep dive in the exercise on banks with high leveraged finance exposures. And what we observed was indeed, and that's what you see on the right-hand side chart, that although leveraged finance exposures only account for around 9% of total exposures, in terms of overall impairments generated in the adverse scenario, that amounted to close to 20%. So they are more risky when you go into a downturn, this type of exposures, although of course they tend to generate higher returns. Now the final slide is a bit about how we use the stress test to support our supervisory review and evaluation, so the SWAP, and how it feeds into Pillar 2 requirements and Pillar 2 guidance calibration. So there are different elements that are taken into account here. On the one hand, we use qualitative outcomes, for example, whether banks are able to properly provide proper quality data in the submissions. If we see weaknesses in that, in terms of the internal governance or their, say, risk data aggregation capabilities, those type of findings in principle feed into the SWAP scores, and through that can have an impact on the Pillar 2 requirements. Secondly, the quantitative impact in terms of the capital depletion issues as a starting point for determining the so-called Pillar 2 guidance. That is a non-binding requirement, but something that comes on top of the capital requirements and the buffers. And here we introduced a new approach back in 2021, which is basically what we call a bucketing approach. So based on your capital depletion, it's a bank, each bank is allocated to one of these 4 buckets. And then our line supervisors, the GSTs, will then use that as a starting point and then take into account different bank specificities, say, also management actions that have been taking place in the meantime since the reference date of the stress test, or other things that warrants maybe an adjustment up or down within or even beyond the buckets in some cases. As a new thing this time around, we also imposed a leverage ratio, P2G, so the stress test also informed that, but here we use the same, say, bucketing approach as for the risk-based capital ratio. But let me stop here and hand back to the chair.
Thank you very much, Christoffer. I think this was a very clear account on the stress test by the ECB, and we'll move later on to the discussions, particularly on the number of banks and the methodologies and assumptions in alignment or not with the European Banking Authority. Now I'd like to give the floor to Nicolas, and then to give the S&P Global Rating view. So please, Nicolas.
Thank you very much, Rym, and it's really a pleasure to be here and to give our views from our perspective on the results of the stress test. I will be relatively short. I think the main messages that I want to give, and I will echo a bit of what Jakob said earlier and what you yourself said, also some of the points that you made. Overall, we value very much the transparency that the EBA has given with this issuance of the templates, obviously. What we have seen from the results broadly confirms our view, which we've been having for a year and a half, of European banks as being, as we see them, relatively resilient to a volatile macroeconomic environment. This economic reset that we are seeing with higher inflation, lower growth, and higher rates. There are controversial forces, of course, at play, but overall we see European banks as broadly resilient, and that's, if you look at the rating actions that we took on European banks over the period, they were net positive, so broadly more upgrades than downgrades by quite a margin in the past 12 to 18 months. That said, we also keep in mind that a lot of the positive elements have been very cyclical in nature, and so what we try to look is for really structural improvements to impact ratings. And we've seen some of that, catch-up stories at bank level, catch-up stories in certain systems, certain countries as well in Europe, and also the build-up of more buffers to support senior creditors. That's a bit technical, but our ratings speak to senior creditors, and banks have been issuing more junior debt recently, so that's been also a driver of upgrades. That said, looking forward, we see financing conditions tightening very much in Europe, with interest rates turning positive in real terms next year. And I think Christoffer just showed a slide showing the positive correlation that this has with cost of risk. So we see indeed cost of risks normalizing going forward. So we're a bit cautious with our outlook for asset quality for European banks next year. And the big story these days is funding costs, with the competition for deposits, the rise and the fact that net interest margins have been increasing, but we think are likely to peak this year. So we are a bit cautious also on the outlook for profits and earnings. But that said, again, a message of resilience. And I think in that context, the EBA stress test confirmed this story with, and I won't repeat the points made by Jacob and Christoffer around better earnings, better starting points in terms of capital and asset quality, and therefore overall the depletion, which is more or less in line with the last stress test, even though the assumptions were much tougher. So that's really a sign of resilience. And we did not take immediate rating actions as a result of that, but we are using the data, and I will show you an example as to how we are making use of the data. In the next slides, I will highlight a few of the points I just made. So on the ratings themselves, this is, and I won't go into the details, but this is our summary of where we stand with European bank ratings. You see, we have a vast majority of stable outlooks, more positive outlooks. This is this blue bar here versus negative outlooks. That's across the top 100 European banks that we rate. So still some positivity in the outlooks relative to negative, but broadly mainly stable outlooks. We rate European banks mainly in the single A category. That's for the average, but the positive outlooks tend to be more for the banks at lower rating levels on average. So that's just to give you a sense of where our ratings stand, and happy to elaborate if there's interest. This slide will speak to one of the points that you made, I think, Rym, which is very important, that indeed stress tests are a useful tool, but they don't cover all potential risks, right? So in our typology of risks for European banks, we see the risk of a painful recession as number one, and that's covered by, in a certain way, by the stress tests. The risk of financial stress, so market volatility, and that also there are very severe market shocks imputed into the stress test, so that's also covered. But there are also other sources of risks, non-financial risks mainly, or more commercial or business model risks for the banks, or operational resilience risks for the banks as well. We have in mind here the impact of cyber attacks, the role of inefficiencies, and the loss of confidence from clients. And we've seen with Credit Suisse, for instance, how this can impact, of course, the standing of a bank. So stress tests don't speak to all the risks that are out there. And I mean, not one exercise can speak to all the risks that are out there, to be fair. So we just have to keep in mind that a positive stress test result is not a clean bill of health on the bank. And we have to go one step further with the analysis. But still, that's a valuable, I think, exercise. Another point I want to make is when you read the results of a stress test, it's very important to put them into the broader context of the methodology and the assumptions that were made. Jacob spoke about the assumptions and how harsh they were this year compared to last time. But if we zoom in on the methodologies, a point that I recurrently made also internally when we look at the results is we should be very cautious not to compare results across geographies. We rate banks globally. So our ratings speak to the same risk, whether this is on a US bank or a European bank. And we have stress test results, for instance, from the US Fed, from the UK PRA, and from the EBA. And we have to be very careful in comparing those results, simply because the methodological choices are very different. And I won't go through all the points that I have here on this slide. It's a pretty busy slide. But on the one hand, you have the US Fed, which runs supervisors models on banks' data. But basically, the banks, as far as we understand, are not involved into the modeling of credit losses or the projections of profits. This is all driven directly top-down by the supervisor. On the other hand, you have the Bank of England, which allows banks to input their plans for the evolution of their balance sheets, for instance, so this dynamic balance sheet approach. They use banks' models for both profit projection and credit loss models. with some supervisory challenge, but without any formal constraints, as far as we've seen in their methodology. So that's another approach, maybe on the other end of the spectrum, and the EBA is maybe somewhere in between with both aspects. So on the one hand, there is a static balance sheet concept, for instance, a static dividend policy, which, you know, in an adverse scenario can be a bit maybe surprising that the bank would continue to pay dividends, even though it's, of course, its financial standing would deteriorate. But I mean, that's an assumption that is made by the EBA. We just have to be aware of it, that's all. And then reliance on banks to model profits and credit risk, except for net fee and commission income, this was mentioned. But with a lot of constraints on the modeling, the staging of loans, etc., certain portfolios like securitized assets, for instance, with prescribed loss parameters, etc. So my point is we have to keep in mind the methodological choices that differ across the regulators that make the results not comparable. So I cannot take the, and I'm in the business of comparing banks across geographies, right? So that means that I can use stress test outcomes as one input, but with a lot of perspective, a lot of salt, and a lot of awareness on these methodological choices. I think that's a key point. So that said, if we look at the results as we've seen them, we look for the 70 banks that are in the sample from the EBA with the starting total capital ratios. That's the yellow bar on top at the start of the exercise, and then how far it goes, and against the overall capital requirement, which is the cross that you see there, and against the minimum SREP requirement, which is this purple triangle. And what we see here is that a lot of banks, I think around half, are breaching their OCR, their overall capital requirements. So that means the buffers, which we don't see as necessarily a problem because buffers are built to, you know, take losses under stress, and that's exactly what they do here. So it's not necessarily a bad thing or a surprise. But we see relatively few to almost no banks, or actually a couple of banks, 2 banks, from what we've seen, breaching SREP capital requirements, which is really the trigger, if you like, for potential supervisory action. And for these 2 banks that I highlight here, like Banque Postale and Alpha, there are specific reasons, both on the accounting side and then some remediation actions that were taken since that, you know, alleviate a bit the impact of these outcomes, and the banks have communicated on that. So I won't dwell too much unless there are questions. So overall, I think that's where we draw the conclusion that this confirms broad system resilience, again, to the risks that were covered by that stress test, which are not all the risks, obviously. And my final slide is how we are, as a rating agency, going to use the results. One example of that is this chart where we just plotted the cumulative credit loss rates. For us, a good question is to understand the actual level of credit risk in the books of the banks that we rate. We have, of course, the NPL ratios, track record of the time, but with this EBA exercise, we get an insight into the models of the banks, how they see their own portfolios reacting to a shock, which is common because it's assumptions made by the regulators, right? So we can see some outliers. We see some banks for which the stage 3, so this chart plots on the vertical axis the stage 3 ratio after stress in the 3rd year, and on the horizontal axis the cumulative credit loss rates. And so this gives you a good sense of the relative riskiness, the relative vulnerabilities of those banks to the shocks, and we can replicate this at each portfolio level. So that's great transparency, and for us it's very valuable insights. Allows us to double check our views on the credit risks that these banks carry. So what I can say, just to conclude, is echo again what Jacob was saying around the, if you want to make the actual templates downloadable, that'd be great for us. And finally, also if the ECB were to disclose similar granular data at bank level on the banks that they conduct stress tests on, that also would help further transparency, I believe, but that's maybe a debate we can have together. So thank you very much. Back to you.
Thank you, Nicolas. I would like to give the floor right away to Marc, and then we can break for the discussion.
Yes, thank you, Rym. I will provide a few comments as a practitioner bank with the supervisory stress test. So first, maybe obviously we think that this exercise shows the robustness of the European banking system, applying an extremely severe scenario, and for us that is potentially an issue to have a scenario design that keeps on being more and more severe on all the variables. So this time we have interest rates where we have a lasting uplift of interest rates in a context of huge depression, and we understand that we could have a period of uplift in interest rates having a shock on GDP, but to have a 3-year period like that with a lasting high level of interest rates in such a shock on the economy, we think that we are beyond plausibility. So once again, we are happy to have European banks showing that they are very robust, but we think that a key component in the stress testing exercise is to have plausible scenarios, and going forward, we keep on adding new layers of severity in the scenario. And that's something that is also playing in the comparison between the outcomes of the various supervisors, notably when we compare to the US, where in fact they've kept more traditional scenario design. So it's true that there are methodological discrepancies, but there is also gaps in the outcomes that are linked to the scenario selection. GDP severity is quite aligned now between the various large supervisors, US, UK, Europe, but the interest rate pattern and inflation pattern has been very different in the various exercises. Another comment that we wanted to make on the process itself, we want to underline that it's smoother this year. It's still obviously a lot of work for the banks. I see that from Christoffer that it's also a lot of work for the ECB, but we admit that notably the Q&A process was very efficient this year. For the first time, we had some transparency on the controls, and clearly supervisory stress test is also a data challenge, and we think it will remain, and it's part of the value addition of that exercise to provide a one-stop shopping on data for analysts, for broad public, and for that there's a lot of work on bank side. And so having transparency on the controls that are applied and imposed in the exercise, notably the blocking controls, as ahead as possible from the beginning of the exercise, is clearly something that will continue to smooth the process. So we welcome this transparency. It came a bit late for the first time, so we strongly believe that having this transparency earlier in the process will even improve our ability to have something which is going faster, both for the banks and for our various supervisors, and notably ECB. In terms of methodological evolution, so Jacob showed the fee modeling, the central fee modeling as an enhancement of the framework. We are not totally on that position. We continue to believe that having central models can create gaps with economic assessment of a given scenario. And when we look at the distribution of fee shocks between the banks, between the countries, the the range is quite wide and not that easy to explain. So we believe that's something worth investigating going forward. Clearly, with this change of scenario design, with the uplift in interest rates, we saw some issue with the methodology on net interest income, which is also now the top-down methodology with very limited leeway on the bank side to have an economic assessment of the impact of a scenario on their net interest income. It raised some parity of treatment concerns this year, notably for French banks. We are supposed to run a static balance sheet exercise, and we have this issue of the repricing of contractually unremunerated deposits in France that really played a strong contribution to the depletion of capital we saw for French banks in this exercise. It wasn't presented in the slides either by ECB or by EBA, but when you look at a country per country average of the outcome of the result, you see that there is, depending on the country to which the bank has its dominant market, there is quite wide range and consistency between the banks of the same country. It's linked to clearly the banking model, whether you are variable or fixed, but it's also linked to some biases in the EBA methodology that are more or less impactful depending on the business model. And so we believe that this issue of parity of treatment of the various business models, not departing too much from an economic impact of a scenario, is something that has to be looked at. In terms of still concerns around the methodology, clearly market business line treatment is still problematic. There are notably around market reserves still lasting impact when in various crises we've seen that you have an impact on the first year, but progressively it's reverting over the posterior years, and that's not taken in the EBA approach. So there again, we understand having a high shock on the first year, even if it's very severe, but track record of various crises show that it doesn't last 3 years, and notably in a plausible scenario. And maybe two additional concerns that remain. One on insurance treatment. We have banks that have meaningful insurance activities, and the way insurance P&L is treated in the EBA stress test is still problematic, with higher depletion for insurance business than for the rest of the banking business. And with a static balance sheet approach, we have the weight of non-performing loans shortfall that is increasingly contributing to the outcome of the exercise. So that's something that would be worth also to analyze in the outcome of this EBA stress test, the contribution of Pillar 1 EBA shortfall on the various banks. Its average for BNP Paribas, it's quite meaningful, and that's mostly linked to the static balance sheet approach. So we think that's something that will keep on growing, and if nothing is done in the methodology, it could be even more problematic for the next EBA stress test. So that's all on my side.
Thank you very much, Marc. So I would like to go directly to the discussion. Before that, I would ask Jacob if you have any comments on the reactions of the panelists. Because I don't see Jacob in front of me in my screen.
So sure, a few. I'm here still. I haven't given up. So I have a few comments, right? So I wanted to say first off, I mean, obviously, I guess Rym, you pointed to this in your beginning, in your opening comments, right? That it's clear that there's also liquidity risk, right? We're not looking at liquidity risk, and I certainly recognize that there is a, you know, maybe we ought to do an EBA liquidity stress test, right? That's not a bad idea given where we are. I may not be loud for saying it, but it's a thought. Then we can once and for all stop mixing up the conversation about prudential capital requirements and liquidity risk, which are, I think, very different in nature. Right? But I certainly acknowledge that liquidity risk is there, right? I can't help but have a little bit of a go at our US colleagues, right? I wonder if they'd done a stress test on Silicon Valley Bank, they wouldn't have spotted that something was wrong, to be honest, because they weren't really doing stress testing of Silicon Valley Bank, right? The other thing I would like to say, and I should have said that, that's a miss on my side. We didn't mention it, but we also did a collection of data on banks' bond holdings, and we published separate numbers on those exactly because we knew that there was going to be a debate about what does higher rates mean for European banks in terms of bond holdings and potential losses, right? Including, again, I am not, so as a former banker, I smile when I say I was a bit surprised that unrealized losses were such a mystery. I mean, I think that's only that they've been there for a long time, right? But now they're bigger. So people woke up and then started asking questions, right? So what we did, I think knowing pretty well that the numbers would be small, is that we collected a special batch of data from the banks, including information on their hedges, the direct hedges, right? Not the balance sheet structure, which is a different question, which is out there. As you will be able to see, it's pretty clear that the European banks in our sample have they hold much less bonds at amortized cost to maturity, right? So the losses, although there are not, I'm going to say roughly 150, 130 billion, I think, not in any way comparable to what you see in the US, right? First of all. Second, and this is a broader point, but I think it's fair to say that if you have, I don't know, 25 trillion euros in bonds outstanding, and somebody raises interest rates, then of course the market value of the bonds are going to go down. The interesting question is not that, it is who holds the loss, right? Where do they sit? It seems to me that the losses sit less in banks than you would think. That's my first comment, right? And they do sit with central banks, which is in a sense easier, at least for other people, maybe not the central bankers, but you know, that's how it is. And then they sit with an assortment of investment firms, pension funds, insurance companies. So I think there is a broader issue, which is there not just for the US, but for Europe, right? If you have a 2.5 trillion euro loss or 2 trillion euro loss on your bond portfolios, who's taking the hit? I think that's a fair question to ask, right? I think what we can say is it's not really so much the banks, because the banks are actually, they have taken some losses, right? The mark-to-market portfolios have been written down as they should, and the amortized cost holdings are simply not big enough to constitute a real concern overall, right? Just to make that clear. So I think we've done some work to at least address that debate, and just acknowledging, yes, we understand, right? But so I don't want to sound, if I sounded cavalier or relaxed about the risks for the banks, that's certainly not the intention here, right? To some of the points raised, I mean, I would say a couple of things, right? I certainly agree with the comment that doing centralized modeling in a very heterogeneous EU banking system is a challenge. I see that some people in the chat are asking if we want to do more top-down. I think the answer is yes. But to the point raised by Marc, I think we want to do it in a way that respects and is reflective of the heterogeneity we see across banking systems in Europe, because I very much agree that one of the challenges we have is that we have banking systems that are predominantly floating rate and some that are much more fixed rate. And in the current setup, I think the fixed rate banking systems get a somewhat rough ride, right? That's by design. I'm not sure it's an accident, just to be clear, but my view is also we should do better in terms of reflecting that aspect, right? And I think, Rym, you had a few comments as well. I think the different nature of the risk profile of the books and the banks is something if we are going to go more towards top down, we need to find a way to do this without giving up on being reflective of the heterogeneity, right? And for those of you who follow the debate, we're still working towards that aim or goal, but we're also trying to find ways to do it that actually makes sense, right? Doing top down just to do top down is not, I think, smart, right? So if the stress test is to fulfill its purpose, it has to reflect in a reasonable manner the systems we're looking at, right? And that's the challenge we have. And that probably needs some creative thinking. There'll be more in the future on this particular topic, but we are in the lab thinking about how to do more top down while still capturing the heterogeneity, yeah, of the balance sheet structure. I think the business models, right, which to me is the same as the balance sheet structure overall, is something we have to be able to handle. If we can't find a way to handle it, I don't think we're ready to go top down, is my short answer here, right? Then it's unwise, right? So, and I can just say, for those of you who are asking, it really is a resource question. As Christoffer and others will know, the amount of resources sunk into stress testing when we do these bottom up is massive, right? I'm not saying there's not a lot of resources that goes into the Fed and the Bank of England, but it goes into reporting of data, not quality assurance and other things, right? So it is, I think it's a resource thing, but it's also quite frankly an agility thing. I think when we've had the last, sadly since 2019, 2020, we've had COVID, we've had a war in Ukraine, we've had a number of geopolitical incidents, and quite honestly, it'd be nice to have an ability to run more frequent stress tests that are more reflective of the current state of play, which brings me to my last point, namely the concern about the scenario construction, which I share. I think we're having the challenge that we're having to trade off the need to do a credible supervisory stress test on one end and making scenarios that satisfy the gravity rules of the economy, right? And I take the criticism that the scenario we have now doesn't really meet the laws of gravity for the economy fully, right? There are some elements there which are just defies logic, right? And that is reflective of that trade-off, which I should say there's a long debate between the authorities prior to this, right? I'm a customer, so I don't get to decide. But those who were in the discussions will know that I repeatedly made this point, that are we sure that we're inside the rules of the laws of gravity here, right? I mean, I think we're at the cusp, right, Marc? I think, and that's a fair criticism. I agree with you that I would rather do more frequent, more nimble stress testing top down that was more realistic, so we could have an easier path here, right? So we have a bit of a super tanker model at the moment, which has this challenge point, right? And it needs to satisfy various stakeholders, which again, right, we're talking a bit systemic risk analysis, we're talking a bit supervisory stress testing, and I think at times we get our wires crossed a little bit in the dialogue, right? And that includes in the scenario construction. On the other things, I would say, I get the insurance P&L, hence our little secret box on the IFRS 4 versus 17. I think that's the generation 0 in terms of acknowledging that point. Static balance sheet, yes, I think that's though more deliberate than by accident, right? This has been discussed again and again. Some of the things we didn't talk about, I think worth flagging that we did. We changed the repricing of deposits, right? So it's a little bit less aggressive this time, which is more realistic, still conservative, but not straight pass through. That would have been even worse, I think, for the French and the German banks if I wouldn't be too far off on the mark on that one. And we also loosened up a bit on the way we handle securitizations to make them a bit more realistic, right? That was very, very conservative in the past. That we also fixed, I think, to a more reasonable level, right? So there are things to come, and I would say to those of you in the chat, we're working on the climate stuff. That will be, I hope, something that has more of a dynamic balance sheet adjustment mechanism in it, and will have a longer time horizon. So that will adjust that will address at least part of that concern, right? That if you do a longer term stress or scenario analysis, you need to find a way to allow the banks to adjust their exposures to make it credible, right? And that is well taken. I'm not sure. I'm a little bit sympathetic to it in a 3-year horizon, but I'm not so sympathetic. But if it's a 20 or 15-year time horizon, I think it would not make any sense if we didn't allow for some dynamic balance sheet adjustments, right? Just to say that to some of the people here, right? Anyway, I think I better shut up now. Thanks.
Thank you, Jacob. You helped me to read the questions in the chat. But there is one point raised at the end, which is the economic value of equity, and whether you had in the EBA stress test, and also this is the same question for Christoffer, the impact of extreme scenario in terms of wiping out some of this in the increasing interest rate scenario. So did you look at that?
I'm not sure I understand the question, Rym. Sorry.
So it's the last question, in fact. It's the impact of the on the economic value of equity in an increasing interest rate. So it's a question in the chat.
No, I don't think we can, right?
The equity shock was extremely severe.
Yeah, exactly. Yeah, exactly. I mean, it's quite severe. I don't
55%, so it's difficult to be more severe.
Yeah, exactly. I was going to say it's quite a. I mean, it's quite a big number if you take it at the way it's done. But it's not. I mean, again, we just got to be clear, right? In the IRBB methodology, which is different, I think you get more realistic numbers, right? Just because we're denying some of the adjustments here by methodology, as Marc also flagged, right? So I would say in the EVE number is quite big, but maybe also not that realistic when it comes to it, right? So we're not giving it that much airtime because we know that we've constrained a lot of things here, right? And I guess that goes to I think Dominique had a question about the hedges, right? I mean, they are partly allowed for, but also partly killed by some of the methodological constraints, right? So you mean 50-50 here, right? Yeah.
Christoffer, would you like to add anything to those questions?
Yeah, maybe on this last point. I mean, of course, as Jacob mentioned, we also did the data collection on unrealized losses, which goes a little bit in that direction. But of course, the IRBB is not, say, compatible with the current EBA methodology, but maybe on the side of the ECB, SSM, we are running thematic reviews on interest rate risk in the banking book and credit spreads in the banking book. So there's an ongoing review looking at explicitly at these things. So it's not part of the stress test, but it is an ongoing supervisory priority, obviously, in the current environment. So it is a focus area, but it's in parallel with the stress test.
Is it fair just to say here, I mean, there's a live debate at our table about the assumptions in the LCR, right? Based on what you saw in Credit Suisse and elsewhere, do we think that the corporate outflow percentages are realistic, right? I mean, I don't think we're going to see a redesign of the LCR anytime soon, but it's certainly a question that's out there, right? The other question is really about the pace and speed of depreciation of deposits, right? Which is a bit of a concern when you saw what happened. I think Credit Suisse is more instructive, to be honest. I'm not sure. I don't want to impose the SVB image on the rest of the European banks. I don't think that's fair. So I'm going to do the Credit Suisse thing and say I think there is a the pace and speed with which you saw deposit withdrawal from Credit Suisse was, I think, a surprise to everyone, right? So I guess there is a debate about that. And I just, for those of you who haven't suffered through years of this debate, the whole handling of unrealized losses and how that is to be treated from a prudential and liquidity reserve aspect is a long-standing debate, right? It was not solved in Basel I negotiations, it wasn't solved in Basel II, and it wasn't solved in Basel III either, because people disagree fundamentally on how to handle it, right? So today, the supervisors are a little bit diverse in views as well. Some have effectively said if you have more than X in unrealized losses, you have to put up capital. Others are basically saying, I prefer not to allow bonds held at amortized cost. I don't want you to have them in your liquidity buffer at all. Others are doing some sort of haircutting, right? But there's definitely debate on should bonds held at amortized cost be allowed to count fully in your liquidity buffer, right? That is the natural regulatory / supervisory response to what you have seen with some of the US banks, but certainly also Credit Suisse. I think there's that is a theme at our table. I can't give you any answers, but I can say it's certainly a debating point in terms of are we or should we do anything, and it's also there at the Basel table. Right? It's not a secret. I mean, it's obviously something people are discussing, right? And I know, as Christoffer said, that a number of competent authorities are out there doing little special missions to the banks and asking them to calculate more severe LCR ratios and whatnot, just to see, right? Yeah. So I think there is this sort of, there is a legitimate, let's say, questions and answers session going on between the supervisors and the banks at this point. Yeah. Just again, back to some of the points you made, Rym. It's not that we're not paying attention. It's just happening somewhere else than in the prudential stress test. Thanks.
I have one last question before we close this panel. Can we safely say that the European Banking Authority and the ECB stress tests are fully aligned in terms of the scenario constructions, assumptions, and parameters? Jacob and then Christoffer.
It's pretty well aligned, right? I mean, I think Christoffer and I have been at all the same painful meetings aligning. So I think we're pretty aligned. I mean, where there is a little bit of a difference maybe is in the disclosure, right? As you also alluded to, Christoffer, and we've done, as you've seen, we've done a little bit of a full Monty and a light version of disclosures for some of the banks, depending on size, because quite frankly, for some of the medium and smaller size banks, it doesn't make any sense, right? The granularity with which you would disclose information is just not interesting, right? There's nothing to be had. I mean, I see our friend from S&P nodding. I just don't think it's worth the marginal cost, you know? So I think there is some difference, but that's more of a bank size. Does it even make sense to have all that detail out there, right? So in terms of methodology and what we do together, it's pretty well aligned, right? I mean, there are other things that the ECB does in its financial stability department where I hope it's not aligned, or I know it's not aligned, that it shouldn't be aligned. So that would be a mistake if they started doing what we're doing, because it's a different kind of exercise, right? So I think that's just another comment, right? That there's obviously other products out there which, quite frankly, should not be aligned because they have a different purpose. Yeah.
Thank you, Jacob. Christoffer, would you like to add anything more?
No, not really, but indeed on the supervisory side of the stress test, of course, we are following the same methodology and scenario. So it's the two exercises that we are running are really run in parallel. The only difference, apart from the disclosure, is that there are a few proportionality treatments of say, some of the smaller banks in our own side of the samples, also reflecting that some of these banks are really special business models, say promotional lenders, asset managers, and so on, for which the methodology in some cases are not making very much sense. So there are a few exceptions there, but otherwise it's really the same approach.
Okay, thank you very much. I wanted to add one last point, which I see the time running, but it's on the sovereign risk, knowing that all countries worldwide are increasing their indebtedness and the risk of the sovereign risk is increasing. So how do you see this and how do you treat this in the stress test? So this is a question for both Christoffer and Jacob.
So the way we deal, just a matter of just to clarify for the crowd here, right? The way we deal with sovereign risk is in the sovereign spreads and the rate level. So we start from the levels at N22 and then we add, basically, right? So we have three buckets, basically, you know, low, medium, and high risk sovereigns, and then we jack up their spreads, right? If my memory serves correct, we get up pretty damn close to spread levels that were there at the peak of the European debt crisis, right? So we're almost up at 2011 peak levels. Now, do we have a sophisticated model that maps debt levels, GDP, whatnot into spreads? I was going to say not fully, but I know that ECB and other financial stability departments feed into that debate. But that's where we end up in terms of what we do in the stress test, right? Now, I'm so a little bit of a facetious comment here, right? But I'm old enough to remember when 80 to 90% debt to GDP was seen as like the final frontier, and beyond that point, that will be the end of civilization and the planet will crack in two, right? We're now at government debt to GDP levels of what, 160, 70, 80% for some European countries, and yet the bumblebee seems to keep flying, right? So I also think that part of the tale here is less truth but more market sentiment and about forward-looking credibility and what do you think is necessary, right? So this idea that debt levels alone make up the whole difference, I'm a little bit cynical here, right? But what we do is we have these spread levels and rate levels that combined make it very expensive for governments and very expensive for banks to, I think Christoffer showed some nice charts that demonstrate that if you look at the floating rate of the market funding of the bank's liability side, the more you have, the more you get hit, right? And certainly in the debate with the banks in terms of what do you do when you replace TLTRO funding, for some of the banks in the stress test that had less central bank deposits they could net out against the TLTRO levels, that meant they had to go out and fund themselves at substantially higher interest rates in the stress test, right? So that's a big gap between pretty cheap, if not outright free central bank funding to going out and borrowing at 5, 6, 7, 8%, right? So obviously, I mean, the higher rates, higher credit spreads is going to hit not just sovereigns, but also banks, right? In reality, right? So I guess to some of those of you who are asking about or banks at the peak, I don't know if that's an equity price question, but I will say this. There's no doubt that the cost base for banks is now going to be challenged because of high pay rises, right? You're also going to see probably high credit risk losses as a result of higher rates. And you are going to see more expensive wholesale funding for some of the banks as things adjust, right? It takes a little bit longer for that part of the pass-through mechanism to hit the banks. So at least my expectation would be that flow through, right? So funding costs for banks, possibly funding costs for governments, higher credit risk losses, that's going to play out. And in due course, I assume banks will end up repricing deposits as well, right? That's not happening yet because there's plenty of them. But down the line, it seems likely that deposits will also be repriced, right? So funding costs for banks will go up down the line, right? That would be my expectation, yeah? Just to take that aspect, yeah?
Thank you, Jacob. Christoffer, would you like to add anything else on this question?
No, I think Jacob was quite comprehensive in that one, but maybe only that indeed the debt sustainability of the sovereigns is taken into account in the scenario calibration of the shocks. So it's a price-based mechanism, but it's yeah.
Thank you. Nicolas and Marc, would you like to have a final word based on what we heard?
From me, thank you. It was very interesting.
Marc? Okay, so thank you very much for this very interesting discussion. I would like to thank also Ernest and SUERF for organizing it. So I close the panel. Thank you all.
Thank you all. Thanks for listening.
Bye-bye.
Thanks very much.
Bye-bye.
Bye.
Bye.